Most traders are looking for a trading system that produces an equity curve like this one. This system should ideally have 80% win rate, minimal drawdowns, and most importantly, should work in all types of markets, regardless of whether they're trending up, falling, or trading in range. A system like this, that's always profitable, is commonly known as the holy grail in trading, and is something that most beginners in this business are looking for. There's only one problem with that. Nothing like that exists. Sorry to burst your bubble, but the good news is that there is one particular thing in trading that is the closest to being the ultimate trading's holy grail as it can be, and yet most traders overlook it. And you're going to learn what it is in this video. You see, there's a problem when it comes to trying to achieve this kind of an equity curve, which is steeply rising all the time. That problem is that the markets have different regimes, all of which favor different kind of trading strategies. More on that later. What this means is that in reality, this ideal equity curve would look more like this when the trading system it belongs to would be deployed in the real market environment. Now, don't get me wrong, this is still a decent equity curve that's showing that the trading system has an edge, at least during the time period on which this equity is based on. It comes with a natural period of drawdown that's highlighted in yellow circle, during which this system is losing money. And this is due to the fact that the market's regime was not the one in which this system is profitable. For instance, market during this time period may have traded in a narrow trading range full of false breakouts, but the trading strategy is built to actually trade breakouts. In this case, it is just logical that the strategy will get into a drawdown. Despite what I just described is completely normal, it's very easy to fall into the trap of trying to optimize this system with a hope to make it profitable in all market regimes and ultimately make the holy grail out of it. And this is a huge mistake and can cost you months or, in extreme cases, even years of progress, and you should avoid it. Every market that's out there trades in different market regimes. Market trades in a range, then it makes a breakout of this range, after which it starts trending, and so on. I've talked about how these basic market structures are created in detail in my other videos, so I'm not going to repeat it here. Now, having a holy grail trading system that is profitable in all of these market phases we see on the screen is simply not possible. Yes, there are some systems which are more robust than others and objectively work better in wider scale of market structures than others, but a single trading strategy that works all the time is simply non-existent. This is not the holy grail I'm talking about here. So if you should not be looking for a single system that's profitable in all circumstances, what should you be doing instead? You should be looking to have a trading strategy for each type of the market regimes. In other words, you should be aiming to diversify your trading. Diversification is, in my opinion and experience, the single closest thing to holy grail in trading as it can be. At the same time, it's one of the most neglected areas by beginners. That comes as no surprise, as most vulnerable beginners simply focus on wrong things in trading. So to demonstrate the massively underrated power of diversification, I'm going to show you how to diversify your exits with a single strategy if your capital doesn't allow for trading multiple strategies. And then I'm going to show you how, by diversifying across multiple strategies, I reduce my drawdown significantly without making any changes to any of my strategies whatsoever. So I understand that not all traders are able to trade a number of strategies simultaneously due to the small size of their capital. In reality, trading a portfolio of strategies in stocks, for example, is very accessible and doesn't really require as high capital as one may think. However, for those with a very small capital, it may be a better idea to start diversifying their exits within one strategy, at least to start with. So let's look at how I do it. This is an example of a trade I made using my discretionary strategy that I trade manually, based on some fundamental supply and demand principles and volume profile that I teach in my course. I entered short on the level of the yellow line and used two different exits in this trade. I always tell my students to use two different types of exits wherever possible to achieve a micro diversification effect within one trading approach. Why? Well, it's because using two exits with the first one being at the very close profit target is so much easier to do than aiming for a home run every single time. Get in this discretionary trade was placed around here, highlighted by green line. As I split the position equally between my two exits, it means that after I got this target filled, I'm in a risk-free trade, right? That's because even if the other half of my position now ends up reaching my basic stop loss, the loss will be offset by the profit I made by the first target. The overall trade result will be break-even less trading commissions. This is the most basic type of diversification that any beginner can do relatively easily without having to go down the route of trading portfolios. Now, what are the positive effects of doing this? Well, firstly, as I just said, this is much easier mentally to do, especially when trading manually. I can tell you I've been trading for a while and I still feel a lot of relief when I manage to close half of my position in my first target, meaning I'm in a risk-free trade. Secondly, even this kind of a micro diversification has a capacity to reduce the drawdown of a given strategy. Drawdown and its control is something that successful traders focus on, whereas the unsuccessful ones focus on as high returns as possible, which are often unsustainable. You see, if I just opted for one type of exit in this trade, I would have aimed to exit somewhere on the yellow line. This was my main profit target. As visible on the chart, this level was not reached. And so I would have kept holding this position through the reversal and into the break-even point. At this stage, I would most likely close this trade on a break-even. However, because I diversified my exits, I managed to get a small profit on the first target and then close the second half of my position on break-even, ending positive. And that's what really matters. You want to get the distribution of your P&L as consistent as possible by using diversification. But let's also have a look at diversification across multiple strategies. These are some of my quant strategies that I trade in stocks, and as I just said, trading a portfolio of multiple strategies is not as unreachable as you may think. You don't really need a huge capital to start with, although in the case of small capital, the trading commissions will eat into the profits more than with higher capital, but that's logical. Anyway, we've got 3 different equity curves belonging to 3 different trading systems that differ in their trading logic, and each of these is suitable for different market regime. That's what I discussed in the beginning of this video. In short, the green equity curve is a conservative mean reversion system, blue is a rather aggressive mean reversion system, and the red one is the trend following system that aims for longer and bigger moves in the markets. Naturally, this trend following system is going to lose its allocated capital when markets go sideways or fall. Conversely, the aggressive mean reversion system is built to capitalize on just that and is surprisingly profitable even when the markets are falling due to its entry technique and low hold times. Now, the whole point of diversification across multiple systems is that when one system has a drawdown period, when the market is not in a regime in which it's profitable, the other system is hopefully profiting. This is achieved by having systems with low correlation to each other. Despite these systems we're looking at here are quite correlated to each other, the diversification is at least partly achieved. Look at this most recent development of the equity curves. While the red and green equities are flat, meaning the systems do not trade because their market regime filters prevent them from trading, the blue aggressive mean reversion system is having a massive run-up during this time. If I traded just the red or green system on its own, then I would have stayed in the drawdown during this period while having to discard most of the signals as the filters used by these systems are saying not to trade. But again, let's not just focus on the profitability in isolation, as that doesn't mean much. Let's look at the drawdowns. I've plotted drawdowns in the bottom section of the chart to correspond with each of the systems in the upper section. As visible here, the conservative mean reversion system in this period had a maximum drawdown of just around 6% and then stopped taking any new positions, while the trend following system kept on trading and lost over 14% during the same period. But what if, instead of focusing on the performance of these strategies on an individual level, we combine them into a portfolio and trade them all at the same time? So instead of just trading the blue system with a capital of say $30,000, we trade all 3 systems and allocate $10,000 to each of them. And here's what happens. Here's how a simple diversification I just described affects the drawdown. The drawdown, the combined portfolio, is plotted by bright green line. In this yellow area, the portfolio would see only around 4% drawdown. Compare that to 10% of the trend following system if traded separately, and you've got a massive difference. I zoom out a little bit and we can see visually at the first sight that the portfolio drawdown is much more stable than that of individual systems. In this area, for example, we can see that 2 out of 3 systems are in a loss, but because the blue system is profitable during this period, the combined portfolio recovers from the drawdown much quicker than the other 2 systems individually. If I should pick one single thing that's as close to the definition of holy grail in trading as possible, then it would definitely be this. One can over-optimize a single trading strategy as much as they want, but that's exactly what they'll get, a massively over-optimized strategy that's not going to work in the future. If you're not in a position to diversify across multiple systems, then at least do it with your exit technique, as I've showed you in this video. That's it for this one. Thanks very much for watching. If you enjoy my content, then please consider subscribing, as by doing so, you help me massively to grow my channel, and that's highly appreciated. This is David, Critical Trading, signing out.